Venture capital is one of the riskiest asset classes. You typically can lose all your money that you're investing. Don't you try to marry both these things, your love for finance and your love for startups. I eventually cracked it after 2 years of starting this process. Two or three major things which I think can be helpful for a lot of people. It was a very lean team, which is very rare in venture capital fund. Your funds was organized by regions. That gave me a lot of experience on, say, where does this money come from or who is this money coming from. Typically, a fund has two cycles. How much money can you make from there? And ultimately, funds or any individual is investing in the sector or any financial instrument or asset class to make money, doing much better than the average return that your portfolio is expecting. And that for most institutional and individuals is VCP. And the kind of risk is also same, like you lose your entire money. Third phase of the fund comes in where what you call portfolio management. Most of the capital that you would see in India is either local or largely coming from US or North America.
Hi, welcome to the first part of this series where I'm hosting Swarandeep, who has been a startup investor himself and is currently leading the partnerships at Recur Club. In this, you'll get to learn how you can approach your career as an investor and how investment ecosystem works around the world. Hey, hi Swarandeep. Thanks for joining in today's podcast. I believe with your journey and your experience in like being an investor, working in big companies like which are like VCs and like investing in funds of funds, investing in startups. I think a lot of learning can be got from this. And I think our audience will be able to learn a lot of things from you. Thanks for joining again.
Hi, Ankit. Thanks for having me. Definitely would love to share my experience and see if that could be helpful for a few people.
Sure. So let's start with your journey. Like after college, how did you where did you go? What did you learn from that? And like how did you navigate to this to becoming an investor and like part of this community?
Sure. While I was still in college, I started getting more interested in financial markets, given that my dad was an independent stock trader. So my first role was more of a combination of tech or engineering and financial services at Sapient. And then because I liked the domain part more than the tech part, I wanted to make a move to the hardcore financial aspect of this industry. So I ended up being at BlackRock, and it was a great experience. Got a lot of exposure working for non-Indian markets, so that was largely US and EMEA. And I think there were a few skills that I picked up there, which was more on like understanding financial statements, understanding finance, on how the entire system as a whole works, or how, say, different value chain providers within the financial services system works. And at that time, I was still continuing a bit of what I started in college, which was helping people get recruited. And when I graduated, it was more with startups, so helping some of the early stage startups hire for, say, CTO, hire for product managers, business analysts, and those kind of things. And at some point of time, I was chatting with someone, and he kind of gave me this idea, because I like doing both. Why don't you try to marry both these things, your love for finance and your love for startups? So that's where I started talking to a lot of people who were already doing the kind of role that I wanted to do. And this was, again, my college alums who were already doing something that I was interested in. So that's where I started my journey to prepare and enter this field. It took me a while because I did not have that exact same say background that they love interviewing with, which is largely management consulting or already working with startups. Since I was not doing both of them, at least formally, it took a bit of time, and I eventually cracked it after 2 years of starting this process. So I started in 2012, ended up I started in 2013 and getting the role in 2015. And what I essentially did during this time was two or three major things which I think can be helpful for a lot of people. One is that while I would say venture capital / private markets investing is not a very hardcore finance role per se. Of course, you have to deal with finance, numbers, all those things, but it is, in my personal view, a bit of sales, because you have to pitch to entrepreneurs and founders that they should take your capital and your money instead of all other capital forms that are available in the market. So it's a selling role. It's a strategy role, because you try to kind of understand, okay, is this market big enough, or how can, if it's not big enough, can you enter into adjacent areas, and those kind of things. So you play a lot of the strategic mindset, strategic thinking role. It's also a bit of recruitment, because when you invest in a company, you start also thinking about, okay, how do I help them recruit the first few founding members and those kind of things. And some point at some stage, it's also a lot of investment banking where you try to punch in numbers, see on, okay, how can my say projections look like? Would somebody buy this kind of projections? Are there any assumptions that I'm making which are not making any sense in the real world? So in that sense, it's a very generalistic role with a big focus on finance, of course. So since I was doing a bit of these kind of things, I think it helped me when I actually landed and cracked that role. And the difference was that this was a non-Indian fund which was looking at investing in India. So some of these biases that at least at the time existed, which was more on what you have done before you kind of take that role, those things were relatively either lower, like non-existence. So they were, I would say, I'm interviewing more for potential than past, like what you have done in the past. Of course, those things are helpful because you're still in the asset management industry at BlackRock. You understand finance. So the basic building blocks are there. And other things that were required is, can you actually build your network and get deals? Can you like hustle and understand sectors? I could give them a glimpse of that in my interview. And this was something that they did not ask me, but why did I when I was getting mentored by my alum who was already in venture capital, he told me a few things that I can do as a, you can say, more as a homework when I am interviewing, which was, can you identify, because essentially they were non-Indian, that's why it was even more important. Can you pick a few areas or sectors that you think are very interesting? This was back in 2014-15. That could be of interest to them. And then once you identify those sectors, can you list like top 2 or 3 firms, and why are they interesting to you, or why are they not interesting to you? Like, what do you think, which direction they should move, which direction they should not move? So I did that exercise. I picked up a few areas, listed a few subsectors and companies within that who were, like, in a way, leaders in that particular business model, and then eventually started with a more say granular on what is good in their business model, what is not so good, which direction can they move, and eventually say other investors who are investing in certain sectors like this. And that gave a very good glimpse of to the interviewees, like that, okay, while I'm not doing what I'm doing, I can actually get my sleeve lowering, and right from like the initial days, I already know a bit of what I would have to do there once I land up. So they got very comfortable with that. I think that was one of the big reasons that I was still able to crack a role in venture capital without having that necessary or that relevant background as such, in a way. And once I landed there, I think my experience was phenomenal. That it was a very lean team, which is very rare in venture capital funds. You typically have a partner, you have a principal, associate, and analyst, or at least a combination of some. In some cases, maybe one person is not there, but then you would have the similar kind of a setup or a structure. But in our case, it was way too different. So we have essentially the group was Spanish, and it was a group company, which meant venture capital was just one of the arms, but they had a mid-sized corporate M&A or a investment bank and a consulting arm. And the consulting arm was the biggest. Mid-sized M&A was like probably the smallest, like 2 or 3 people. And then funds was organized by region. So there are 4 funds, two for Spain, one in early stage, one a growth stage fund, one fund for Latin America that was going Mexico and Colombia, and one for India. And they just had one person who was directly reporting to the partner, and those partners were common. So all the 4 funds had common partners, and which is a very unusual structure. You would not typically find it in most of the firms, I would say, or maybe all of the firms. So what it meant was that it gave you a lot of flexibility and also a lot of say challenge and hustle that you had to do, because you are in a way covering entire spectrum of venture capital funds life cycle or journey. So starting with the typical process is that you raise a fund, which is basically raising money from LPs or limited partners, as you call it in VC parlance, which is people or individual, not individuals. Individuals can also be there, but these are typically ultra HNI or HNI that have that kind of wealth and ticket size that they can invest. But it is largely institutions that you would typically look at, and these institutions would be family offices, which is a structure that a family has created, which has a lot of wealth, and they want to manage that wealth. And it could be a single family office, which means only single family, or it could be multi-family office, which means a lot of families get together and then they invest together as a whole. So family office is one, pension funds, insurance companies, development financial institutions or DFIs, And you have a bunch of other fund of funds, and there are a bunch of such other players. That gave me a lot of experience on, say, where does this money come from, or who is this money coming from. The second part is, once you have raised a fund, you start to look at startups and companies that you can invest into. So you develop a pipeline as you are still raising a fund. And as soon your fund's first close is done, so typically a fund is typically divided into two. It could be more or less, but typically a fund has two fundraising cycles. So you call it a first close and a second/a final close. So first close could be anything about, say, 30-40% of the entire fund's corpus. So if I'm raising a 100 million fund, I would maybe do a first close at, say, 25 million or 30 million. It not necessarily does not need to be a complete 50-50. It can be anything which is, say, 25-30% of the fund. So you do a first close, you start investing into a few of those companies, and then in the meantime, you're still raising a fund and you go to a second close. And in every geography, you get a certain time limit by which you have to close the fund. So, for example, in India, it's typically 18 months. So once you do the registration with the SEBI, you get an approval, you start the fundraising, you get 18 months to do your full and final close. It cannot be an open-ended fund that as people keep coming in, you take money from them. So in India, open-ended funds are typically not permitted by SEBI on the venture capital side or this side. There could be other asset classes and other forms where you can still have maybe open-ended fund, but not venture capital. So once this pipeline is identified, you start investing, and then you basically look at a lot of companies, you develop a pipeline, you develop your thesis on, see, which sectors are interesting, which are not interesting, which which are the top teams in that particular sector and subsector that you would want to go with. You do both a relative local comparison and global comparison. You do a you move back into your analysis where, say, where would this company be in 5 years in terms of revenue, multiples, and if this is a multiple, what value I'm investing at today, what multiple would I be able to get? So these are all of course, all ballpark and in your head kind of calculation, but that gives you a very good idea, say, what you can make out of this investment if you end up investing, and the outcomes could be entirely be different. But what this exercise helps you is to get a back of the envelope calculation. So what can your multiple be when you exit? How much money can you make from there? And ultimately, funds or any individual is investing in this sector or any financial instrument or asset class to make money. And if he or she does not feel that he will be able to make money, they don't invest in that opportunities. So that's why you see on an average of 100 companies that would approach a fund, they would invest eventually into just one or two companies, and sometimes not even one or two companies. And the return is, and the reason is simple, that the companies that they see, of course, there could be an n number of reasons, but ultimately all those reasons are combined into one big reason, which is that they don't feel that they will be able to get the kind of return that they expect from this particular investment, and from on the fund side. So one is on the individual company level, and then you have multiple companies in that fund that you're investing into. So both on the individual level or on the collective fund level, they don't feel that they will be able to get that return. It could be that the market size is not big enough, the team is not good enough, there is a lot of competition in this space, and some of the companies have already progressed too much. There is a lot of regulatory problems. So there could be n number of reasons which can come up, but all of them are leading to one single thing, which is this will not give me the kind of return that I'm expecting. And of course, venture capital is one of the riskiest asset classes. You typically can lose all your money that you're investing into, and that's what you're investing for. That my typical public market investments give me a stable, like in Indian side, you can expect about 12 to 15% on a normal regular cycle from public markets, mutual fund kind of investments. But because you want to have your entire portfolio return much higher than that, you invest into a small portion of your entire portfolio amount or corpus into risky investments, which is, say, alternative, VCP, hedge funds, real estate, and all, which is a larger bucket called alternatives. So anything that is not fixed income or equity would fall under the alternative bucket. So real estate, gold, commodities, VCP, all those things. So you invest a small portion of that so that your entire portfolio return can be dragged up upwards. So instead of just a 12 to 15, you on a portfolio level, you can expect, say, 18, 20 or 25. That can happen if a part of your portfolio is doing much better than the average return that your portfolio is expecting. And that for most institutional and individuals is VCP. And the kind of risk is also same, like you lose your entire money and your one of the investments can actually return the entire amount that you have put in angel, PE, VC kind of investment. So it's a power law that you call it, like one or two of your investments in a 10 portfolio is driving the entire fund returns for you, or your entire portfolio returns for you. You start looking at the portfolio that you're building. I can actually for the count number of funds. Once the investment is done, you have closed the agreements based in the EU, wired the money, that are looking at India. The third phase of the fund comes in, where you what you call portfolio management. So you help them, say, get into new products, new business lines, hire people, increase their revenue. So there are like the entire startup cycle comes into play when you are doing the portfolio management. And eventually is the exit, that you have been in the company for a few years, and then you want to monetize the asset or the stake that you have in the company with somebody who is wanting to buy that stake, and that where you cash out your money. So because I was the only one, uh, I have seen those all the four cycle, but in not in the same order, I would say. So when I got into the fund was investing. So I was doing stage 2 and 3, and the eventual goal was, because in some time our investment period was ending. So typically in a VC fund, you have about a 8 to 10 years life cycle. So if for first 4 years are typically investing, which can be extended by the LPs by a year or so if you have a provision, depending on the fund prospectus that you have. So it becomes 4+1 and then another 4+1, which means in first 4 or 5 years, you're just investing. And the next, after the fifth year or fourth year, you start divesting your stake from those companies. So when I entered, I was in the second phase where we were still investing. And then eventually, once those got to the end of the fund corpus that you have invested most of the money that you held, you are now reserving the last part of your fund corpus mostly to do follow-on investment. So you have already invested in a company, but the company is raising a new round, and you want to either maintain your stake in the company, because with every capital raise that you are doing, you dilute your equity. So if today you held 10% and a new round is happening, the 10% will go maybe to 8, maybe to 8.5, depending on the exact numbers that you have. So depending on the dilution of the company. So there could be a way where you want to maintain the percentage stake that you held before that round happened. So you do follow on rounds, or sometimes you are very thrilled by the performance of the company and you want to invest more than your stake. So you want to increase your stake from 9 to 10%. So you invest a larger sum of money if you have rights and if you are able to have that conversation, and there is a possibility to do that. A part of the corpus is left for your follow-on investments. So essentially, as soon as we started I started making a couple of investments. One, our fund was nearing its investment period, which meant we could do only follow-ons. And second, then we had to start thinking actively about exits. That now we want to exit this company. So when I got in, I worked on a few investments and then eventually got into the exit mode. So let's now start looking at selling our stake into companies. So till the time I stayed, I exited 3 companies and made two investments. Yeah, I made 2 investments and 3 exits. And eventually, because we were ending our fund, we wanted to raise the next fund. So that's where like my fundraising experience came in, where like you have to build a fund pitch deck to your LPs, both your existing as well as new ones that you're approaching. So what goes behind when you raise funds? How do you develop the fund strategy? What is number of companies you're looking at? What will be the ticket size? So you get into all those details and things. And I started doing that for the second fund, but eventually we decided that that was not the right moment because of certain developments that happened in our first fund and the portfolio that we had. So eventually we thought, okay, maybe this is not the right time. We will start the fundraising in another 6 months or a year. Until then, I can concentrate on the exits part of the thing that was there. But by virtue or by chance or coincidence, I ended up being at a couple of forums, and I was attending events where there an opportunity came where we could become a fund of funds other than the direct fund that we're investing into. We never knew whether that will convert or not, but we had an opportunity where there was a potential or possibility to become a fund of funds. So we spent next 6 months kind of developing a fund deck for that, pitch deck, pitching LPs, developing a pipeline of funds that we can invest into. So that gave me a very good visibility on what do LPs look at when they're investing in a fund, which is like, okay, how long has the team been in place? Like, do they have experience in this sector? Have they done previous investment? What was the track record of those investments? How many of them were, say, sourced in their local geography? How do they source these companies? Like, do they have a advantage in terms of securing these companies? What stage they would be there? So do you do the entire evaluation of funds, and you do multiple rounds of conversations and data screening and data evaluation on those? So I just did that for a year because I wanted to be more closer to investing into startups than funds. So while I did that for a year, but I eventually moved on from there. And then when I moved into the other role, that was a non-investing role. So I was very fascinated by this whole thing about sustainability. So I took a new role into that. But what I did was that I started, yeah.
Before going into that, can you talk about, you said about the Spanish fund that you worked for, right? At that time, I think this is around 2014, 2015.
Yeah,
If
I entered in 15 and stayed till 2018.
Yeah. So how was their perception about India? Like,
Hmm.
how much of their portfolio size were they willing to put in India? And how has that changed over time? Because you are in this ecosystem, want to understand how has the
Hmm.
Indian perception changed over time?
Hmm. So yeah, I think Spain slash Europe has very limited capital in India. That most of the capital that you would see in India is either local or largely coming from US or North America. Of course, there is pockets of capital from Middle East, from Southeast Asia, and all those places. But larger pocket is North America, and then I think India locally has been coming up decently well as well. But the largest pocket till now is still US or North America. When it came to Spain or the Spanish fund particularly, I think approximately, I would say about 10% of the overall assets under management was in India. So we had, I think, about 200 or 300 million assets under management. And this was an Indian fund was about $20 million kind of a fund. So approximately 10%. So they were very excited about India. I think this was the first fund that they had for India, which meant that they were also learning a lot of things on what works, what does not work, how does the ecosystem operate, does not operate. And that's the reason that initially they hired me to be based out of Madrid. But then realized that because there was somebody else before me who was looking at the same role that I was doing, and it was very tough for her to have a very strong hold on India, given she was based in Madrid. So even though I was hired in the same arrangement that I would be based there, we actually flipped the model that I stay here and then go there because the team was there, the partners of the fund were there. So overall, I think Spain slash Europe is very excited about the development since that time. But somehow, I think in terms of risk appetite or in terms of risk capital, Europe still does not have that kind of risk appetite that is needed in a country like India. Because of course, while we have a very large demographic, we have a lot of, say, young age population, consumption patterns, and so many things that are going in India's favor. They still don't understand it, and I think they are right in a way, because unless you spend time understanding markets in a very detailed manner, which would mean a lot of trips to India, a lot of doing a due diligence on the ground stuff. Till then, you cannot get convinced whether you should still invest. And I personally have tried beyond that Spanish fund I was working in, like working with other funds that are looking at India or want to look at India eventually at some point of time. I think like the typical DNA that we have, or the typical culture, working culture, normal living culture, they still, or most of them are still not able to comprehend that in a way. So I can actually count number of funds on my fingertips that are based in the EU that are looking at India. So either they are very large late stage funds, so they would come at Series B, Series C, Series D, which would that by then the company would have already established a PMF, they would have already established revenue, they already know a large part of their business model. And so a lot of these things are sorted. But when it comes to early stage investing, like pre-seed, seed, pre-series A, series A, they still shy away from that. They don't understand that well enough. And rightly so, because unless you commit to India in a very full-fledged manner, which means opening an office, having local people come and do those investments, till then it's very hard. And not just with Europe, like any country you take, unless you decide to establish an office for doing early stage investment, it's going to be pretty hard. Late stage investments can still work from outside, because then you're counting on local funds that have already invested in that company to kind of refer those deals, and you can evaluate them more from a very hard number perspective, specifically when the company is Series B and onwards. So that part is still lacking, I would say, and naturally India gravitates more towards US, Southeast Asia, because one of the language. I think in Europe, language is a very big challenge. Each country has a very different working culture, living culture, language, economy, demographic, and so on and so forth. So, and even if you see Indian startups, they don't see Europe as a normal destination or a first destination that comes to their mind. It is always either Southeast Asia, Middle East, or the US that these startups even look at. So, I think maybe that would improve over time. But right now, maybe LP capital is still there. Some amount of maybe I have seen a few of those family offices and other players in India investing in Indian funds, but direct funds investing in India are very, very small, very like handful, I would say. I think situation has improved a little bit since then. Like when I was there, I think early stage from Europe, I think we were the only one probably. And there was still a lot of late stage. So World Invest, Sofina, I'm not able to recall others, but like two or three. Now you have Hummingbird, you have Speed Invest looking at India. There would be a lot of others that even I am not aware of, like who all are investing from Europe, but there are still much more than it used to be.
I hope you liked this episode. The next part will be out soon.